In 2008, millions of people lost half their wealth. At the same time, certain portfolios went up. In 1930, while the broader stock market declined close to 90% from its peak, certain balance sheets expanded. Assets changed hands. Capital moved. In 2020, during the fastest market drawdown in modern history, the same structural pattern repeated itself. Specific asset classes absorbed billions in institutional flows, while the majority of portfolios contracted sharply. These were not different markets. They were the same market, operating under a different set of rules than most participants understood they were playing by. Crashes don't destroy wealth, they transfer it, which raises a question that is structural, not speculative. If the same markets produce such divergent outcomes across such different historical moments, the explanation is unlikely to lie in timing, or luck, or access to information. It lies in architecture. Most investors believe markets are one game, a single system with a single logic: growth, participation, accumulation, buy, hold, compound. History suggests something different. History suggests there are two games, and most portfolios are only equipped to play one of them. The design of most modern investment portfolios reflects a specific set of assumptions that are rarely stated explicitly, but are embedded in every allocation decision nonetheless. Those assumptions are that credit will remain available, that growth will continue, that confidence in the system will be sustained, that the expansion of asset prices reflects durable structural value, and that this expansion, with time, will resume even after temporary disruptions. These assumptions are not unreasonable. For long stretches of financial history, they have been correct. But financial systems are not linear, they are cyclical, and those cycles are not uniform. They operate on two fundamentally different logics that reward opposite things. The first is what we might call the expansion game. In expansion, the dominant logic is growth. Credit is abundant. Capital is cheap, risk is rewarded. Narratives drive multiple expansion. The future is priced aggressively into the present. Assets tied to anticipated earnings, to innovation, to momentum. These are the assets that accumulate value fastest. The second is the contraction game. In contraction, the logic reverses entirely. Credit tightens. Liquidity becomes scarce. Capital that was deployed freely begins seeking a different kind of destination. Not the highest possible return, but the most defensible position. Survival and solvency become the dominant institutional mandate. Two games, two different sets of rules, two entirely different definitions of what makes an asset valuable. Most portfolios are built for prosperity, very few are built for stress. This is not a critique of any individual strategy. It is an observation about structure, about the mismatch between how most capital is allocated and the full range of conditions that financial history consistently produces. To understand why contraction creates different winners, it helps to examine what actually occurs structurally when a financial system enters a stress cycle. Not the headlines, not the sentiment, the mechanics. Systemic contractions tend to move through three distinct phases. Phase 1. Liquidity shock. The first phase is mechanical. When confidence breaks, whether triggered by a credit event, a rapid rise in interest rates, a geopolitical rupture, or the simple exhaustion of a leverage cycle, the immediate effect is a contraction of liquidity. Assets are sold not because investors have changed their long-term views, but because they must. Margin calls force liquidation. Risk models automatically reduce exposure. Institutions redeem positions to meet withdrawal demands. Result is a broad, often indiscriminate compression of asset prices. Multiple contraction arrives quickly. Assets that were priced for an optimistic future are suddenly repriced against an uncertain present. This occurred in 1929, in 2008, in March of 2020. The triggers differed. The mechanism was structurally consistent. Phase 2, capital reallocation. Here is where the analysis becomes instructive. What happens to the capital that exits those positions? It does not disappear. Institutional capital, the capital that moves markets, operates under mandates. Pension funds, sovereign wealth funds, insurance portfolios, Endowments. These entities cannot go to cash indefinitely. They cannot hold a position of zero exposure. They must allocate. And under stress, the criteria by which they allocate change fundamentally. They move toward assets with lower default risk, assets with lower dependence on credit expansion, assets whose demand is inelastic, meaning demand that persists regardless of the economic cycle, not because of it, assets backed by something tangible, structural, or essential. Capital doesn't vanish, it migrates, and it does so according to institutional constraints and mandate structures that most portfolio designs never explicitly account for. This migration is not random, it follows structural incentives. And because institutional volumes are what they are, when that capital moves, it moves markets. Phase 3. Structural advantage. The assets that receive these institutional flows during contraction tend to behave differently from the broader market. Some fall less severely, some recover earlier. In certain historical periods, within certain asset categories, some have appreciated while broader indices declined. This is not coincidence, it is structure. What is worth noting is not simply that these assets perform differently, it is that they were structurally selected for. Institutions did not migrate toward them by accident. They migrated toward them because those assets satisfied conditions that the contraction environment made non-negotiable. Assets that are not dependent on growth assumptions, that carry inherent scarcity, that serve essential demand, or that function as stores of value when confidence in financial instruments weakens. These are the assets that fit the contraction mandate. They are not positioned well because of luck. They are positioned well because of what they are. What follows is historical analysis, a structural examination of which categories of assets have tended to absorb capital during contractions, and more importantly, why. This is not a framework for what will happen. It is a record of what has happened, and the structural logic that explains it. 4.1. Hard monetary assets gold, and the companies that produce it, occupy a specific structural role in the history of financial crises. In the 1930s, during one of the most severe deflationary contractions in recorded history, gold mining equities significantly outperformed the broader market. During the 2008 financial crisis and its aftermath, gold appreciated substantially while other asset classes were in distress. The same pattern appeared, with nuance, in subsequent periods of dollar weakness and institutional uncertainty. The structural mechanism is not complicated. When confidence in financial instruments erodes, when the creditworthiness of counterparties becomes uncertain, when the integrity of paper claims comes into question, capital historically seeks something that carries no counterparty obligation. Gold holds no debt. It cannot default. Its value is not contingent on the continued functioning of any institution. It is important to add precision here. Hard monetary assets are not growth assets. They do not generate cash flow. They do not compound over decades in the way productive assets can. They are volatile. Their performance is highly dependent on the phase of the monetary cycle. They are stress assets, most relevant during the specific conditions of systemic uncertainty and monetary instability. Outside of those conditions, their structural advantage diminishes. Treating them as permanent portfolio anchors misunderstands their function. Understanding them as cyclical instruments with a specific structural role is more accurate to the historical record. 4.2. Sovereign debt during deflationary stress. In 2008, as equity markets collapsed globally, long-duration U.S. Treasury bonds did something that surprised many observers at the time. They rose. Yields fell as prices increased, and institutional capital flooded into the safest available sovereign instruments. The mechanism is what is known as the flight to safety. When systemic risk spikes, institutions rebalance toward assets that are unlikely to default, that offer predictable cash flows, and that fulfill the mandate of capital preservation rather than capital growth. In a deflationary, stress environment, one characterized by falling prices, falling credit creation, and falling demand, sovereign debt issued by credible governments has historically served this function. But intellectual honesty requires an important qualification. This pattern holds specifically in deflationary contractions. In inflationary environments, where the contraction is accompanied by rising prices, currency debasement, or sovereign creditworthiness concerns, the dynamic can reverse significantly. Sovereign debt can become a source of loss rather than protection. The historical performance of this category is not universal. It is conditional on the nature of the stress itself. This distinction is not a footnote. It is central to the analysis. Capital flows during contraction are not uniform. They depend on the structural character of the contraction, and conflating one type with another produces conclusions the historical record does not support. 4.3. Productive land and essential infrastructure farmland, basic energy production, and utility infrastructure occupy a different structural position. Not because they perform dramatically during crises, but because of what they are at a fundamental level. Productive land generates output regardless of market sentiment. A farm produces food whether equity markets are rising or falling. A water utility delivers service whether credit is expanding or contracting. An energy infrastructure asset generates cash flow because demand for energy is inelastic, not because the business cycle is favorable. Historically, across multiple contractions and monetary regimes, assets tied to essential productive capacity have demonstrated resilience not through dramatic appreciation, but through the maintenance of real value. Land, in particular, has survived currency crises, sovereign defaults, inflationary spirals, and deflationary collapses. The asset itself endures. What changes is its ownership. Financial assets can evaporate. Productive assets endure. This is not a romantic claim about agriculture or infrastructure. It is a structural observation. Assets whose value is grounded in physical productive capacity carry a different risk profile than assets whose value is grounded entirely in financial narrative, credit availability, or sentiment. 4.4. Consumer staples and essential demand. The fourth category is the most straightforward in its logic and perhaps the most instructive in its mathematics. Consumer staples, companies that produce food, household goods, basic healthcare products, and other non-discretionary items, do not typically double in value during contractions. Their performance is not dramatic, but what they have historically demonstrated is a significantly reduced drawdown compared to the broader market, combined with earlier recovery. The structural reason is simple. Their demand is not discretionary. People purchase food, medication, and basic hygiene products in recessions. Volume may compress slightly at the margin, but it does not collapse. Revenue streams remain relatively stable, and because institutional capital needs somewhere to go that fits the contraction mandate, essential demand, lower default risk, operational stability, these businesses tend to absorb flows that exit growth-oriented positions. The mathematical insight embedded in this is underappreciated. Avoiding a 50% drawdown is not equivalent to finding a 50% gain. It is structurally superior. A portfolio that declines 30% when the market declines 50% begins recovering from a fundamentally different position. The compounding advantage of avoiding deep losses is more durable than the compounding advantage of chasing high returns, particularly for capital that cannot afford to lose years of growth simply recovering lost ground. This asymmetry is not widely modeled, but it has been consistently present in the historical data. The natural question, if these historical patterns are this clearly documented, is why are so few portfolios built to account for both games? The answer is not ignorance, and it is not conspiracy. It is incentives. The financial services industry, in its structure, its revenue model, its regulatory design, and its cultural orientation, is built around participation. Assets under management grow when markets grow. Advisory fees scale with portfolio value. Product innovation is oriented toward capturing upside, toward efficiency in normal conditions, toward meeting demand that is itself shaped by years of expansion. The dominant investment frameworks of the modern era, broad index participation, long-duration equity holding, diversification across correlated growth assets, are rational responses to the conditions that have characterized the majority of the past century. They are not wrong. They reflect a genuine historical truth, but they are optimized for one game: The UE financial industry optimizes for participation, not protection. This is not a failure of individuals operating within it. It is a structural reality, one that shapes what gets built, what gets distributed, and what becomes normalized as standard portfolio construction. The incentive to prepare for contraction exists almost nowhere in the architecture of the industry itself. The consequence is that contraction, when it arrives, tends to find the majority of portfolios in the same position, exposed to the same factors, vulnerable to the same liquidity dynamics, subject to the same forced reallocation pressure. Not because of individual failure, but because of systemic design. It would be a mistake to read this analysis as a prediction. It is not. What history records with considerable consistency is a structural pattern. The major contractions in modern financial history have been preceded by a recognizable set of conditions: an extended period of credit expansion, the inflation of asset prices beyond underlying productive capacity, and the gradual erosion of institutional caution, what might be called complacency at scale. These conditions do not carry a timestamp. They cannot tell us when. They can only describe what the historical record shows has tended to precede systemic stress events. Repeatedly across different eras, different geographies, and different asset classes. The pattern is not the prediction. The pattern is the observation. And the observation is this: the structural sequence of credit expansion, asset inflation, and complacency has preceded the most significant contractions with enough regularity that its recurrence warrants consideration, not as certainty, but as a feature of how financial cycles have historically resolved. What changes between cycles is the specific trigger. What has remained structurally consistent is the underlying mechanism. We began with an observation. Crashes don't destroy wealth. They transfer it. The reason that transfer happens, the reason certain positions absorb capital while others relinquish it, is not timing, and it is not prediction. It is structure. It is the difference between portfolios built for one game and portfolios that carry some architectural awareness that a second game exists and operates by different rules. Financial history does not argue that contraction is inevitable at any particular moment. It argues that contraction is part of the same cycle that produces the expansions most portfolios are designed around. Both are expressions of the same system. Both follow structural logic, and the capital flows that define each phase move according to institutional constraints, mandate requirements, and risk frameworks that are largely invisible to those who only observe markets at the surface level. Understanding both sides of that cycle is not a posture of pessimism or caution. It is a posture of structural completeness, an acknowledgement that the range of conditions financial history produces is wider than the range most portfolio architectures are designed to accommodate. Whether that gap matters and how is a structural question each participant in markets will answer differently. Through allocation decisions, through the time horizons they operate within, through the assumptions they choose to examine or leave unexamined. What this analysis offers is not a conclusion, it is a frame. We don't follow the news, we analyze the systems that create it,